G'day traders, Stacey Burke from Stacey Burke Trading, and today I'm going to go over what I consider to be my bread and butter trading for the end-of-day trading, and why I look at end-of-day trading, and how that possibly might be something you want to add into your toolbox. So we're looking just at a pound yen cross chart. It doesn't matter to me. You can put this on any chart you want, but what you want to do is put up a blank chart. On this particular chart I've got a 20 period moving average, but we'll just look at something. I'm going to put on here the average true range. So if you go up to your tools in MetaTrader and go into, insert indicators and throw up the oscillator, we'll just take a look at the average true range of the British pound yen. And I like this pair. It tends to give off fairly good volatility, although the last couple of years it's definitely lessened, but still, you know, somewhere, if we just look at the average around this blue line area, somewhere around 200 to 230, 250 pips. This month's been a little bit lower for its average daily range, but still averaging roughly in the area of 150 pips. You can back this up and have a look, and you can see that, you know, during high volatility, or even, you know, just back in this sort of range, we're still doing 160, 150 pips. That's the average daily range. And if we look at the weekly range, you'll see that this pair sort of the average would be around 450 pips roughly somewhere, and currently right now we're up, you know, 500-600 pips. So what that means is the average range that the pair moves during the week. And then, of course, the monthly range, I'd say we're somewhere in the region of 900 pips, would be a sort of a medium-term average. Somewhere between 600, 700, 800 pips, definitely. So if we go back to this daily chart, and we'll just get rid of this indicator. So what that means is that potentially, the reason I like end-of-day trading is that if you're doing day trading, and you know, you're probably at a minimum going to be risking 25 pips on one of these pairs, and you're probably aiming for, you know, hopefully at least 50 pips, but on sometimes you may only get 20-25 pips before the market turns. And that's what's challenging about day trading, is that you spend a lot of time at the screen, and often you're looking at maybe 1-to-1, 2-to-1 risk reward for a lot of screen time. But on these daily chart time frames, you know, 150 pips, if you're risking 25 to 40 pips, you're looking at least 3-to-1. But if you time these right, and you're looking at the weekly range, maybe 400 to 500 pips. Now again, whatever instrument you're trading, you should definitely be looking at this. And then the other sort of factor with that is you want to be looking at the spread. So in this particular case, the pound yen roughly is 2 to 3 pips. It'll probably get less during London in the US. But again, if you're risking, you know, 4, 5, 6 pips on a trade, and you're going for 20 pips or 30, 40 pips, it's still a fairly, you know, that's a big chunk of your movement that you're giving away in commission. So you should be aware of that as well. Whereas if you're trading end of day, it definitely puts the odds in the smaller traders' favor. You can position yourself potentially in a long before a move starts to really explode, and you potentially have a low risk and higher reward opportunity. So if we're looking at this daily chart, you know, if you haven't looked at my other videos on opening range, go and do that. Opening range was something that Toby Crable worked on and Market Profile talks about, and it's roughly the first couple of time frames. In this particular case, if we're looking at a monthly range of say 700-800 pips, that first couple of days of the month has a high probability as potentially holding as a buy or sell level for probably at least half the month, if not for the whole month, and if it's trending strongly. So this information can really be a huge asset to traders. And today we're going to go over some ways that potentially can put the odds in your favor of positioning yourself on a Monday to Friday basis of that weekly, 400 pip range, sort of average range for the week, how we can maybe position ourselves with a high probability trading setup. So Looking at the daily chart here, how can we do this? So what we want to look at, actually we'll go back to the daily again. I don't have weekly bars set up. This is a Monday that's printing right now. But again, if we look at the first 2 days of the week, you can go back and test this out for yourself. That's a Monday, Tuesday. Okay, so again, the Tuesday was the low. And then we Friday, Thursday, Wednesday, Tuesday. So we've got a Monday, Tuesday set up here. The Monday was the low. Tuesday was the low in this particular case. And on this particular case, Monday was the high. This particular case, Monday was the high for the week. So if we went down now to, let's go to an hourly chart. And we'll look at this last few weeks. So this is a Friday. That was a payrolls day actually. Thursday, Wednesday, Tuesday, Monday. Now what we want to be looking at to make this really simple, if we know that there's a high probability possibility, and we've drawn our levels on our daily chart of support and resistance levels at turning points, and we know that 80% of the time maybe Monday or Tuesday can be the low or the high for the week, we want to be drawing our highs and lows on a Monday, and we want to have that 20 period moving average on there. So the yellow area is London Open, the pink is Asia, the green is the US. Now if we know when Wednesday morning opens up that 80% of the time one of those first 2 days is going to act as a low or a high, and we see that Monday's low has been tested and then rejected. Monday's high has been traded through, and now we're seeing that market consolidate back towards the moving average. And this is again that little pattern we talk about where we see a high or a low established. The market in Asia breaks out. That first hour of London again continues to move north. Let's say if you're trading this end of day and you can't be on the screen during the day, you can see that on Wednesday morning the market again gave us this gift. So Wednesday morning, or for evening if you're in North America, we see that the market has trended. It's now high probability that Tuesday is the low for the day. We're trending strongly through Wednesday. Now we want to look at that range. So as of Wednesday morning, we've got a high of 135.89 and a low on Tuesday of 133.33. So at that particular point, we're looking at approximately 350 pips. So we'd have to be, let me just check that in, 250 pips. 250 pips. So we're looking at maybe 200 to 300 pips still of movement, somewhere in that range. And we know it's a payrolls week. This is a fairly low risk trading opportunity. So the question is well, how would you position yourself in that trade? If you were taking that position purely on the close of the market and you were to get in at the open at 135.83, you'd have to be at a maximum at that 1 hour low, which is 135.22. So you're looking at about 90 to 70 pips, 70 pips of risk. So again, we're looking for potentially 200 pips of movement. If we put 200 on top of that 85, 89, 90, we're looking at least 37.90 roughly. But again, we're with this particular pair, we're prepared to trade this and monitor our position at the next morning's close. We see that the market has still stayed above the moving average on Friday morning. Okay, we've gotten 1-2 thrusts down. We can now move our stop to break even, as that market should definitely not come back and test this if we're going to get a retest of this high. Now it's being a Friday, and we know that we want to be exiting the market possibly at some point before the close of the market. We're either going to set a target at that high level or at our 3 to 1, which would give us 210 times with 3590, so 36, 37, 3800 would be a 3 to 1. Or we can possibly, we want to be at break even definitely when the payrolls release comes out. And if you're up and these hours are North American hours and you're awake and you have access, you can either put a limit order in to exit at a certain amount, or if you were to possibly trade this, you can exit either on a price target of your own or trail that on a 5-minute, however you want. But there was definitely a 3 to 1 risk reward. But the main thing I want to point out here is that number one, we had a range break on Tuesday. We had a compression pattern within the moving average above the breakout and below the high on the Wednesday. Thursday, you could have added in extra position again if you were comfortable to take that on. And again, both of these instances, you were able to place a stop in place. And again, I would suggest that you're going to be looking at really nothing greater than 50 to 75 pips as a maximum. And the reason why that is that's approximately half ATR of a daily, so we shouldn't be seeing that come back if this is a trending market. You've either set your target in place, a limit order, or you're prepared, if you have access to being on the screen, to follow that. Once it clears that high, you want to be definitely looking to exit as it's blowing off. Now, if we were to look at this a little bit differently, we're looking at the 4-hour chart. Again, this may be the dotted lines in this case are the beginnings of the week. So Monday morning. Another way to keep this simple, you can put your levels on there. If you're only able to trade first thing in the morning, or if you have access during the day, you'll see that in this particular case, there's going to be several opportunities, whether you make that exact bar or not, that the market gives you 2 or 3 opportunities over 8 to 12 hours often to get back into these trades. So if you're not prepared to trade a breakout, you might be prepared to trade a follow through pullback. And again, all we're looking at here is simple support and resistance levels. So we had a pullback bar that clearly went out of range again and pulled back. Bulls came back into the market at the lows of the pullback. Sorry about that. And again, we're heading into a payrolls announcement on the Friday. And again, you can see where traders were able to add into positions. So again, there's anywhere from 200, 300, if you were early into the week, maybe 400 or 500 pips in this trade. And again, you're just staying on side of the moving average. I'm going to just go and show you another example. Let's just scroll back here anywhere, but I'll give you a really simple process to sort of get in the habit of doing this. So we're going to, this particular day is a Monday right here. And the first thing I do, Tuesday, midday around London Open, which would be around 2 a.m. New York time, is I draw the high and the low of the Monday. Okay? This is a really important situation because clearly you can see where right here is the London Open. One of my main rules always is I never want to be going against the moving average, ever. Unless I clearly have a final flag blow off, which you can read about in Al Brooks's book. But again, if this is our Monday, our Tuesday, Wednesday, Thursday, Friday, and again, we had no pullback whatsoever on the Wednesday, potentially I'd be looking for that at some point during the week. We look at our range. So we've got 36.81 and a low on the Wednesday, 28.77. So you're looking at 500 pips of movement. At some point after this bar is printed, I might be suspicious that we might see this market pull back as we've done our average weekly range for the week. So when you use the ATR, you want to be sort of paying attention to that, whether you're day trading, whether you're trading the end of day on the weekly range. You want to know those ranges and then get suspicious of when you see price action starting to change, of where things could be starting to slow down and consolidate. So use this to your advantage. Again, then we go into the next week. You can see the Monday tested those lows from the Friday, and same strategy again Monday, Tuesday. So if I was going into London Open, I'd only want to be going in one direction according to this. So keep it simple, traders. Use Monday and Tuesday opening range. Look at your highs and lows. Stay on side of the moving average. Look for momentum. Pay attention to the weekly range, and keep your risk low. Hopefully this video helps, traders. Keep it simple. Stay focused. Stay disciplined. Stick to a duplicatable strategy that's really simple, that you can use week in and week out, and stay focused. Hopefully this helps, traders. If you like it, please share it on Facebook. I appreciate all the questions, but this is, as I said, this is my main basic sort of approach to the market. It's not complicated. It's very straightforward. Sometimes obviously it's not as simple as getting big explosive moves. So when it's not right, stay out. Look for a different pair and to see if there's anything cleaner or easier for you to trade. But these are the very simple strategies that show up week in and week out. Have a great trading week, and may the markets go with you. Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburktrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.